Okay, so in my previous video on capitalism, I talked about why we might be feeling that there's something wrong with the current system and how wealth inequality happens in the current society. Please refer to my episode 1 video and episode 2 video to get a sense of the overall situation. Just to recap episode 2 on how wealth inequality happens, the key points are the following. Number 1, when the world is recording a low growth with no notable innovation, this triggers fear in people, which leads people to spend less actively and focus on preserving their income. If people spend less, money circulation decelerates, which leads to companies making less money, which further leads to people losing more jobs and making less income. Number 2, now, when the world is recording a low growth with no notable innovation and people are losing jobs and spending less, the Federal Reserve and the government steps in, starting with lowering the interest rate. Interest rate is the fundamental basis of discounting the future cash flow yielded from an asset, and therefore, if the interest rate is lowered, the future cash flow becomes more valuable as the denominator in the formula is lowered, leading to a higher valuation of assets. Number 3, less spending under a low growth economy coupled with asset prices and valuation going up causes either a crash in the asset price or a depression, which leads to the Federal Reserve conducting a QE. If the Federal Reserve conducts QE, this is basically the same as pouring oil on a burning fire. This brings the valuation of assets to the next level, with money being injected into financial institutions and asset management companies. And in order to preserve their balance sheet, those institutions would now search for assets to purchase, which would lead to the asset prices going up even more. Therefore, relatively wealthy people already owning assets or who have invested in assets prior to the QE phase become richer, and the ones who didn't do so or didn't have the chance to do so become relatively poorer. Okay, so enough of the recap. So we reviewed all the problems and the issues in the current capitalism system. Today, I wanted to talk about what is needed to solve the problems in the current society. So let's walk through some scenarios. Okay, so in order for capitalism system to be sustained, as I mentioned multiple times in my previous videos, we need a strong growth driver. Now, when I say a strong growth driver, I'm talking about something which can increase our real GDP growth to over 4% without the help of lower interest rate and QE. The definition of low interest rate is an interest rate which is below the GDP growth. Now, in the US, the last time this happened was in year 2000, right before the dot-com bubble bursted. Real GDP growth was over 4%, and federal funds rate was at over 6%, and there was no QE. This basically means that despite a super high interest rate environment, the economy was organically creating so much value, mainly backed by the new innovation, which was the internet. You may argue that this was an illusion and that it was the stock market bubble that drove the growth. I partly agree. However, it is worth noting that this internet-driven growth didn't just happen in 2000, but it started from 1996 when the GDP growth was at almost 4% despite an interest rate of over 5%, and also in 1997, 1998, and 1999, which all recorded GDP growth of over 4% under a high interest rate environment. Given we need a benchmark, I want to use the most recent historical example as a benchmark to determine what a strong growth driver is. Bubbles burst, but we should not deny that the internet was an innovation which awarded the world with a strong growth driver which was sustained for many years from middle of 1990s to early 2000s. Okay, so having that said, achieving a 4% growth without a low interest rate and a QE have now become almost impossible. The reason is there's so much debt in the current society compared to the level in early 2000s that raising the interest rate have become a huge risk. Now, as I explained in my previous video, if the interest rate is kept low, the wealth inequality gap will continue to widen. So it's a condition that is absolutely necessary. But realistically, it is not possible. Just by looking at the federal debt of the United States, in 2000, the debt balance was at around 6 trillion, and today it's at 37 trillion. Now, household debt has also increased significantly, and therefore raising the interest rate under the current system is a huge challenge. Now, in order to increase the interest rate, below conditions are need to be met. Number one, the Federal Reserve needs to have the comfort that the economy is doing very well to the extent where an increase in the interest rate will not harm the economy. For example, if the GDP growth is already recording a 10% growth, even if the Fed increases the interest rate by 100 basis points, the GDP growth may go a bit lower, but it'll still be high enough for the Federal Reserve to have comfort. What the Federal Reserve does not want is a recession when unemployment rate goes up significantly due to a high interest rate. If the GDP is already growing by 10%, the Federal Reserve will have more than enough comfort to increase the interest rate given high GDP is already generating a lot of jobs. Number two, the Federal Reserve needs to have the comfort that the US credit will not default even if the interest rate increases. Generally, when the world is recording a high GDP, demand for other nations' sovereign bonds increase, and therefore, any country's credit risk will decrease. But the Federal Reserve really needs to have the comfort that such a scenario will not happen. Number three, the Federal Reserve needs to have the comfort that people's income is increasing in a healthy manner, that households will not default even if the interest rate is increased. Okay, so as you may imagine, meeting those conditions are extremely hard. The only solution is to have a strong growth driver which can allow the Federal Reserve to increase the interest rate. Also, given QE is now proven to incur inflation, QE is not a viable option anymore. So it is fair to say that what the world needs is a strong growth driver which creates a mass amount of jobs and increase people's income, which can, number one, decrease fear in people's mind to incur more spending, and number two, increase the interest rate to potentially cool down the valuation of assets to bridge the gap between the rich and the poor. Okay, so what are some ways to have another growth driver in this world? I can think of two scenarios to solve the problem. Now, the purpose of having new growth driver is to increase the GDP growth of the world. Now, there are two ways to achieve a GDP growth. First way is to increase the GDP growth significantly from here. Second way is to significantly decrease the GDP significantly from here so that we have a lower base to increase the GDP more easily. Before we go into the details, just a reminder on the GDP concept. GDP is composed of four factors: C, G, I, and X. C stands for consumer spending, G stands for government spending, I stands for corporate investments, and X stands for net exports. So basically, in order for GDP to grow, at least one of consumer, government, or corporate needs to spend a lot of money. Okay, with that, let's look at the first scenario first. Now, the world's GDP is around $110 trillion. So in order for the GDP to grow 4%, the world would need to generate 4.4 trillion of value. Now, the World Bank recently forecasted that the GDP growth for 2025 is expected to be around 2.3%, which would already be reflecting all the new innovations which came out, including AI, robotics, electric vehicles, and etc. Therefore, in order to achieve a strong GDP, we would need another 1.7 percentage points of growth, which would imply that we would need around $2 trillion of additional growth from somewhere. Now, based on my research, there are two instances when a single innovation contributed to around 1.5 trillion or more growth per annum. Those were the internet and smartphones, which encompasses all the new platforms that came out to operate on the smartphones as well. Now, this would basically mean that we would need another innovation which is as powerful as the internet and the smartphone. Now, from here, I tried to search for some industries which can increase our GDP in the short term, which is in the next 5 years, and long term, which is in the next 10 years. I got some help from ChatGPT, so please take that into account. Now, in the short term, these are the industries which has the potential of driving the growth. Generative AI, which may add around $1 trillion of growth per annum. Satellite internet and space communications, which may add $0.5 trillion of growth per annum. Fintech and DeFi, which may add $0.5 trillion of growth per annum. Drones and autonomous trucks, which may add $0.5 trillion of growth per annum. Industrial robotics, which may add $0.3 trillion of growth per annum. Okay, so these are some potential candidates. Now, these are very valuable industries which we have in the world at the moment. However, some limitations are as follows. Number one, all of these industries are somewhat already being deployed in the current society, so it is hard to tell how much net GDP these industries will add, even if fully commercialized. Number two, considering that all of these industries are already being deployed and we're not sure how much net GDP these will add, it is fair to say that we'll need at least 3 to 4 industries of the list to be fully commercialized and adopted in the next 5 years or so. Number three, a lot of these industries benefited off the low interest rate and QE in the past and are still benefiting off the liquidity which were provided by the Federal Reserve and the government in the past. Now, while I think all of these industries are valuable, I'm actually a little bit doubtful that multiple of these industries can be fully adopted in the near term. A lot of these industries, including Gen AI, which requires huge data capacity and electricity power, satellite internet and space communications, as well as autonomous trucks and industrial robotics, which requires massive R&D and capital expenditure, fintech and DeFi, which face huge government regulations, all need to overcome significant challenges and near-term losses to enable these innovations. Okay, so now let's look at the long-term potential drivers which may enhance our GDP in the next 10 years. Fusion energy, which may add $2 trillion of growth per annum. Space solar power, which may add $1 trillion of growth per annum. Asteroid and lunar mining, which may add $2 trillion of growth per annum. Quantum computing, which may add $1 trillion of growth per annum. Brain-computer interfaces, which may add $1 trillion of growth per annum. Interplanetary logistics, which may add $2 trillion of growth per annum. Okay, so the common aspect of the long-term drivers are that, one, these industries are so nascent that we have no clue how much investment and time it'll require. But, number two, while being nascent and unpredictable, these industries are seemingly so innovative that the value it could add to our society is massive. Now, up to this point, what are your thoughts? My thoughts are the following. Number one, I'm personally quite doubtful that any of the short-term innovative industries can make a dramatic impact to the world's growth, given the limitations and the smaller scale of the value it could add. Number two, I'm more inclined to bet on one of the long-term drivers, such as fusion energy and space mining and logistics, becoming a game changer. However, it seems very remote. Number three, however, both short-term and long-term drivers would require massive short-term loss-making investments, which would require the interest rate to be lowered and maintained low for a long time. Okay, so that summarizes the first method of growing our economy through innovation. Now let's move on to the second method, which is to significantly decrease our GDP from here so that we have a lower base to increase our GDP more easily. Okay, so the whole concept of this method is basically this. Right now, the world's GDP is at 110 trillion, which is massive. In order to increase our GDP by 1%, we need an industry which generates 1.1 trillion of additional value every year, which basically requires a whole new industry. However, what if our world's GDP suddenly drops by 50% to 50 trillion? In this case, we'll only need 0.5 trillion of additional value to increase our GDP by 1%. This basically means that it'll be much easier for us to achieve the same GDP growth versus what we're experiencing at the moment. Okay, so what we need in this case is a significant drop in GDP. Historically speaking, there are a few instances when this happened. Number one, Great Depression in 1929. During this period, across the 3 years, the world's real GDP dropped by around 15%, which was the greatest percentage drop since the establishment of capitalism. Number two, World War II. In 1945 and 1946, the world's real GDP decreased by 10% in a single year. Number three, COVID-19 pandemic. in 2020, the world's real GDP decreased by 3%. Number 4, global financial crisis. In 2009, the world's real GDP decreased by 1.3% in a single year. Now, looking at this, you may realize that a GDP decreasing is also quite challenging. The reason it is challenging, especially in the modern world, is because the Federal Reserve and the government uses monetary and fiscal tools to the extent they can to save the economy. But on the other hand, it is notable to say that a massive economic downturn like a Great Depression or a worldwide physical collision like the World War II can significantly deter our economy, which we can use as a lower base to regrow. Basically, if a large-scale war happens, the entire world will need to go through a significant rebuilding process, which will trigger all of C, G, I, and X to expand in the short term. This will generate jobs and opportunities for the people who survived the war. Of course, I'm not supporting a war to happen at all. I'm just stating the facts. Okay, so steering away from a war, what would be helpful and easier for us to grow the economy is to have a negative economic impact like the Great Depression. During the Great Depression, the reason it impacted the world so much was because the Fed and the government took limited actions to address the problems. I personally think that in 2008, when the global financial crisis happened, had the Fed and the government didn't initiate programs such as a QE or TARP, we may have had a fairly impactful reset in the economy, which would have made the overall future economic growth more organic and healthy. However, I don't think such scenario is likely. The world's military technology has evolved so much that a large-scale world war is not really meaningful anymore. If a world-scale war erupts, it would potentially mean a mutual destruction of everyone on the planet. Now, there are small-scale wars here and there, just like what's happening in Russia and Ukraine and what happened in Iran and Israel. However, while those wars in certain regions in the world may continue to happen, a large-scale war like the World War II is very unlikely given the significant implications it may bring to the world. Also, based on the recent trend, a global depression type of economic impact is also unlikely given the Fed and the government are now too used to the monetary and fiscal policies which have been driving the world's growth in the past 2 decades. If the economy is threatened, the Fed and the government will take actions to protect their political agenda. Okay, so I've laid out all the solutions which we may have to address the current cracks in the society. To summarize my thoughts, number 1, the reason high unemployment and unequal distribution is happening is due to the lack of growth drivers, which leads to the world leaning more and more on the Fed and the government's liquidity. Number 2, in order to solve the current problems in the system, we need 3 conditions. Number 1, we need a strong growth driver. And number 2, the growth driver needs to be powerful enough to generate huge amount of jobs globally so that people's income from labor is meaningfully increased as a whole. And number 3, the growth driver needs to be powerful enough for the Federal Reserve to comfortably increase the interest rate. If we achieve all of those 3 conditions, unemployment problem will be solved and the wealth inequality will also be less of a problem. Number 3, there are 2 ways to secure a strong growth driver. One way is to add a huge additional GDP on top of the current world's GDP. There could be potential candidates industries in the short term and the long term. However, from my perspective, short-term drivers look relatively weak and we may need to wait for the long-term drivers to emerge. Number 4, the other way to grow our economy is to slash our current GDP significantly from some large-scale physical collision or an economic downturn without any Fed or government support. However, I also feel like these are unlikely scenarios given how the world has evolved until today. Okay, so where does that bring us now? I personally think that the current low-growth economy coupled with significant wealth gap will linger in our lives at least for the foreseeable future. I have high hopes on the long-term drivers such as fusion energy and space mining and logistics being the world's savior to take our economy to the next level and steer people's mindsets away from purely speculating on assets. We may be looking at next 10 years of time frame for something meaningful to emerge in our economy. Now, having that said, how should we act to address the problems we're facing until a meaningful economic growth actually happens? I suggest we do the following. Number one, while the job market is tough, we should look for the best jobs out there. By best job, what I mean is a job which, number one, pays us the most, and number two, which we can learn the most. Now, I said a similar thing in my advice to Gen Zs and Millennials video, but please focus on what I said. We need to find a job that is most challenging and pays us the most money at the same time. I say this all the time, but the reason this is necessary is because it'll equip us with the right mindsets and skill sets to invest more logically and successfully down the road. I'm speaking from my experience. Without my work experience, I would never have invested successfully and most likely got swayed away with my emotions. Everyone has different standards on the income they can gain from a job. If you're earning $1,000 per month, try to find a job which you can earn $1,500. If you're earning $10,000 per month, try to find a job which you can earn $15,000. Once you feel like you've reached a certain point where you feel like you've hit a ceiling of an income you can reach from a job, try to keep the job for over 3 years. That way, it'll equip you with the right mindsets, which will be extremely helpful when investing. Number two, we need to leverage our income to invest. But to accelerate our profits, I really suggest leveraging the Federal Reserve's monetary and fiscal policies as well as government policies so that we invest at the right time and invest in the right stocks or financial instruments. I explained everything in my stock investing strategy for everyone video, laying out different dimensions of monetary and fiscal policies and how we can leverage the policies to our advantage. Please watch the videos carefully and see if it may suit your investment strategy. Number three, when you feel like you have spotted a very credible and strong investment opportunity, please don't be afraid to go all in. I know there are a lot of investment principles and strategies out there, including diversification. But in a world like this, if you feel like you have spotted a very convincing opportunity, I wouldn't recommend you being too afraid to invest your money. I already explained how I spotted opportunities in my previous videos. Generally, if the following conditions are met, I'm sure you're in a position to invest a large sum of money in the market. A, you have been working a day job for 3+ years and you feel like you have gained the patience and endurance to wisely invest in the market. Just to repeat what I said in my previous videos, I started working from early 2010s and only started investing from 2019 when I felt like I spotted a life-changing opportunity. B, during the times when you're working, you have diligently saved money to the extent you can, and you care enough about the money that you're wisely foregoing false opportunities which happens almost every day in the market. C, while you're working and saving up the money, you also follow the news and the macro for a few years that you generally have a good sense of the directions the Federal Reserve and the government are taking. D, you have developed your view on which industry you think will drive the growth. Now, in the next 5 to 10 years, I don't believe it'll be something fancy. I believe that the industries which have been driving the growth in the past decade will continue to drive the growth. This includes tech platforms, semiconductors, cloud computing, and AI-related software service providers. Apart from those, if you have a decent view about growing industries, you should develop your own thesis. E. Once you have done all of A through D, while monitoring the market, if the market drops by more than 20% or more for any reason, just like how the market dropped a lot due to tariff in April or due to inflation in 2022, depending on your view on the future outlook of the market and the valuation level of the companies which you believe will drive the growth, you may have a chance to invest a significant amount of your savings into the market. The reason I believe this will be an opportunity is because based on our analysis on today's capitalism, I do not think the Federal Reserve or the government will have the chance to keep the interest rate very high for a long time and also will not be able to completely wipe out quantitative easing from the market. Okay guys, so that concludes everything I wanted to discuss about today's capitalism. Now, I do understand that this is a very subjective topic, And I wanted to cover this thoroughly, from assessing the problems to probing potential solutions to how we should take actions accordingly. Now, most of the things I said are my personal opinions, so I would really appreciate if you could also let us know your thoughts on how you think about today's society and how you think it'll play out in the short to mid term. Thank you guys for watching, and I'll be back with more videos very soon.